All right, good morning, everyone. We have a lot to cover today, so we are going to move pretty quickly. So let me go ahead and jump right in. We're going to be going through the state of the real estate market. This is going to look a little different than what we usually go over, my friends. And part of the reason being is that the last couple of weeks and what we've seen, even in the last week, we just saw another rate change at the Federal Reserve level. And so I think it's an important time for us to kind of review what is happening in the real estate market as a whole. I covered a little bit of this before. You guys have heard this in some of the meetings that we do. And yet I thought it would be relevant to kind of go through really understanding what is happening in the real estate market and the economy as a whole for how we can showcase this and share this with our clients. So with that being said, we're going to jump right in. As always, I start with the TCPA. Anything that we share here, if you are going to be sharing anything with your clients, please make sure to do that in a TCPA friendly and compliant way. All right, moving on along. I have Luis Mendoza here. I'm going to have him come off of mute, and that way he can go ahead and give us an update about what is happening in the mortgage world right now, especially as of last week. Luis?
Yeah, sure thing. Well, I actually have some numbers prepared from this morning, but guess what? The rates actually just increased another tad bit in the last, 10 minutes or so. So I'm going to give you the numbers that I had this morning, and I'm going to give you sticker price shock. But the rates right now, as we're sitting here, are 6.9% for FHA, and a conventional loan has an average rate of 7.423, and VA loans are at 6.923. So that is definitely the highest we've seen in years. So of course, it behooves us all to just be prepared to do to really pre-qualify our clients, because now it's more important than ever to make sure that you have the right pre-qualification, because not a lot of people are going to be able to afford the payments that we're going to see at these kinds of rates. We are getting ready to counter some of these rates with programs of our own. For example, the 1-2 punch that we call, which is basically buying down points for your loan, so that when you come in to the loan, you're going to be in the 4%. The following year, you're going to be the 5%, and the third year is going to adjust to par. So that's one of the programs that we're using. And of course, if you have deals that are in escrow right now, one of the things you definitely want to do is, instead of lowering the price of the property, if the buyers are trying to negotiate with you, go ahead and try to negotiate for a buy down of points instead. That is definitely going to behoove your seller, and most likely it's also going to benefit greatly on the buyer's side. So if you like some more answers, some more other tactics that we can use, go ahead and give us a call. I'm going to put my email and my phone number right there on the chat. And also, if you have listings that you'd like to advertise, I'm going to be doing a radio show this week, at least 3 days this week, so I can talk about your listings. If you have a listing you want to promote, go ahead and email me at the email I'm going to put on the chat, and I'm going to go ahead and advertise it for you. Of course, all the leads and everything go back to you, okay? And that is all I have, guys. Rates are really high, but we're ready to counter all this with programs of our own. So go ahead and contact us if you have any questions.
I appreciate that, Luis. Thank you so much for sharing. And I'm going to note, my friends, right, part of the reason that we're going over what is happening in the economy, what's happening with rates, and doing today a little bit different, is because one of the things that I said probably at the beginning, towards the beginning of the year, was that I would not be surprised if we hit 7% or even 8% by the end of the year. And here we are. Right now, with that being said, that doesn't necessarily mean that we're in a situation where we can't continue our business, right? The last couple of years have been, we've joked that it's kind of been a gift from the real estate gods with rates being as low as they have been. And yet what we're going to talk about today is some of the historical data around this, because I think it's incredibly important that when we see this kind of increase in rates, right now, one of the situations that we're going to combat when we're talking with our clients is their short-term memory, right? And that means is they're looking at what has happened in the last couple of years and how different it is right now with these new rates hitting 6.9, hitting in the sevens, right? And yet, if we look at historical market data and we really understand what is happening in the economy, we understand what rates were historically, we understand appreciation at a high level, then it changes the conversation. Right now, more than ever before, is our opportunity to really educate our clients about real estate as an investment. Franklin D. Roosevelt calls it one of the safest investments in the world. And Andrew Carnegie said that real estate was the #1 place that millionaires are made, right? So I think that's an important thing that we need to look at as we understand and go through this. Now with this, of course, all the charts, I have to have my disclosures in here. So there's the disclosure on this, and you'll see sources at the bottom as well for all of the data. So we're going to start today with going into the U.S. economy. We've talked about this in the past, the gross domestic product and where it has been and what a recession is. Now, a recession, right? A recession is defined as 2 consecutive quarters of a negative GDP. The last recession, other than the one we are in right now, we'll go over the quarterly data next. The last recession that we have experienced in our lifetime was in 2020. So I'm going to say that again. The last recession that we have experienced in our lifetime was in 2020. Of course, most of us remember the recession back during the last housing crash, which we can see that negative here. And yet we saw a major negative decrease in the GDP as we kind of went into this pandemic environment with COVID-19. Now, with that being said, we also saw a major jump in the GDP following that. So let's go ahead and jump right over here. We can see that right here in Q1 of 2020, we were at a negative 5.1. Q2, we were at negative 31.2. That 2 consecutive quarters of a negative GDP put us into what is considered a technical recession. Now, anytime we go into a recessionary environment, the government will take steps with 3 tools to kind of stimulate the economy, right? Their main stimulation of the economy comes from 3 places. They own a good percentage of the stock market, and so they do some stuff with the stocks. They have mortgage-backed securities, and they allow those to burn off their balance sheets. And of course, with interest rates, they adjust the rates. Interest rates in this particular case were kept low, right? Were kept significantly low for the past kind of 2 years. For 2020 and 2021, we experienced very low interest rates that stimulated borrowing, which meant there was a lot of purchases that were happening. There was a lot of movement that happened in the real estate market. Now, there's a lot of other things that come into play. Of course, the stimulus checks, the PPP loans, right? All of those different factors that were geared to infuse money into the economy to stimulate that. And we can see that effect in Q3 of 2020. We saw a major jump in the gross domestic product. Now, what's very interesting is during that same time, even though right now we are in a time in the economy where unemployment is very low, where there's a lot of job openings, where there's a lot of cash that is in the market right now, consumer sentiment has remained fairly low. It did go up a little bit in June, but since February, it's been fairly low, and it is lowered since then. This is essentially, right, what is it that consumers think when they are looking at the market as a whole, not just real estate, but in terms of purchasing. Now, a lot of this, right, what happens, we see gas prices spike up, which has a lot to do with inflation. And so we see, oh my gosh, the gas is too high, right? All of these things that kind of contribute to how we feel about what is happening in the economy. Now, unemployment, right? We can see that over here. So we can see that in 2019, we had an incredibly low rate of unemployment at 3.7%. In 2020, we saw a major jump in unemployment, and that started to decrease as we entered at 2021. But let's look at what happens on a monthly basis, right? So obviously we're looking at that annual. In 2020, we saw a shutdown. That meant unemployment jumped up extremely high, especially in industries like hospitality, right? We saw a lot of restaurants that got shut down. A lot of people weren't traveling anymore. And so we saw a big hit there. Where unemployment stayed really low was in these industries that were kind of considered that essential industry. And so we can see that as we progress through this kind of pandemic environment, unemployment has kind of returned to pre-pandemic levels. So we're about 3.6. We're at about 3.5 here. That is very, very low, right, for unemployment. What that means is that more people currently have jobs than are unemployed right now. The rate of unemployment is incredibly low. Now, when we look at job openings, however, the number of jobs that are still available is also incredibly high. This also contributes to some of what we're seeing in the environment right now, is that because there are more job openings than there, so supply and demand comes into play here, similar to the housing industry. Because there are more job openings, people are demanding what? Higher wages, right? Better benefits, all of these things that come with there being an increased amount of job openings and yet a very low rate of unemployment, or even individuals changing jobs or changing industries happens a lot right now, right? Now let's look at inflation. Inflation is an incredibly important number. This is probably one of the biggest indicators of what we will see happen with interest rates. And so that's important to look at. Now, when we look at right, so we're looking at the CPI, we can see inflation has been incredibly high. It's actually higher than 7.04 right now, but this is a very interesting number. What we are seeing right now, so I want you to kind of look through this, and we look at the 90s where we had about 6.1. If we were to go further back, inflation has not been as high as it is right now since the 80s. Okay, since the 80s. So we don't see that on this chart here. We can see a height here in 1990 at 6.1%, with the core CPI being about 5.2. Core CPI as a result here is at about 5.5. Now, part of what the government is looking at doing is, again, they see this high inflation number. They see this recessionary environment that we're in, and their goal is to decrease that number. Right? Their goal is to get that number down. And the way that they do that is when they increase the interest rates, they stop some of the borrowing that is occurring and some of the spending that is happening in the economy right now in order to get that number down. So it's one of the three tools, mortgage-backed security, stocks being the other two, so that they can be really aggressive about this inflation number. And they have been very aggressive. That's why we've seen consistent rate hikes occurring. That's why we're hitting the 7s in our interest rates right now. That's part of the reason that we're experiencing that, is this inflation number that is staying consistently high. Now, I wouldn't underestimate the government's response to what is happening in the market, because in reality, they will continue to play with the rates until it does what is needed in order to get this inflation number as one of the factors to where it needs to be. So this is really important as well, to kind of have an understanding of that. Now, what about construction? Now, and this is important as well. When we talk about what is happening in the economy right now, and we talk about this inflation number being as high as it's been, we know that when it comes to home prices are dictated by supply and demand. So price is dictated by supply and demand. When there is a low amount of supply and there is a high demand, prices go up, right? This is economics. When there is a lot of supply and there's not a lot of demand, prices go down, right? Or there's adjustments in that price to compensate for the lack of demand so that the product still sells. This happens in every single market, real estate being one of those markets. Now, construction is important here because construction is the amount of new supply that is coming into our real estate market, right? Into our real estate inventory. What we know is that post the last kind of housing crash that occurred within the US economy, we saw a major dip in the amount of construction that was occurring within that given market. We know that the historical average, right, the historical average of construction that occurs per year, it's meant to be around 1 million, right? It has been very low. We saw an uptick that happened here in 2021, and yet this number has basically remained fairly low. Part of what contributes to this and what has contributed to this, especially in the last 2 years, is a couple things. When we've come into a national pandemic, right, or a worldwide pandemic, it didn't just affect our nation, it affected the entire world. One of the things that it contributed to, aside from a decreased workforce for a while there, right, because some industries were shut down, is we started having major supply chain issues, which meant that the cost of goods that it takes to construct, the cost of goods for everything, right, but also the goods that it takes to construct new properties, that went up. So the cost of building went up. The ability to acquire materials went up. We saw that even in redesigning our own office, that for a second there, we weren't sure that we were going to get the flooring material that we wanted because it was stuck on a ship somewhere, right? And we started looking at other options, including importing from the East Coast, until all of a sudden, honestly, by luck, because they had told us that there wasn't a timeline, that shipping container happened to be unloaded, right? And all of a sudden, there was an increase in supply of the material that we were looking for as it was unloaded, right? So this kind of supply and demand that is playing out in the construction industry, as well as the supply chain issues, is contributing to the fact that we are still remaining fairly underbuilt. Now, given how we return to technically about the historical average, yes, but does that meet population increase? Not really, right? So that's going to be really important as well. With that being said, builder confidence is also low right now. Again, that gets contributed to the supply chain issues, cost of building, and kind of this lack of confidence on whether they're going to be able to recoup their costs, whether there's going to be enough demand for the supply. And yet here in California, we know we are still massively underbuilt. So this depends on different areas. Institutional buyers. Now, what is an institutional buyer? And I think this is another area that is incredibly important when we look at what is happening in real estate right now. One of the things that we see is institutional buyers are going to be these kind of companies or institutions that have a high amount of cash and they can buy at a big portfolio level. So let's say, as an example, that you get a new builder that comes into town. They build out, right, property. Now there's two options that they have. They can sell on the open market and sell one-off to individual buyers, right? And so in reality, might they get a premium? Well, it depends, right? Again, supply and demand comes into play. So if supply is low and demand is high, then they make more money, right? But it also takes more time, it takes more energy, it takes more marketing. What if an institutional investor comes and says, hey, you have 50 homes and I'm going to buy 50 homes from you, and I want to buy them at a discount, and I want to just buy them all from you right now, and you're going to save on time and money, but I'm buying on a discount. That's an institutional buyer, right? So that's a really general example of what that looks like. There are more types of institutional buyers. A lot of these companies that are doing cash offers on properties, they could be considered institutional buyers as well. So what we can see is there are certain markets that are more highly impacted, at least within the last year, by institutional buyers. We may see these numbers begin to change. A lot of times when we experience a market where the amount of supply starts to go up and demand goes low, is a great opportunity for institutional buyers to get product at a discount. And so we may see these numbers change. California at least is about 9%. We're right on that cusp into the next level of percentage of institutional home buyers. And yet we can see Texas is pretty high at about 28%. So just to kind of give you a look at what is happening on a national basis. Now, there are going to be a couple shots that you may want to screenshot. All these slides will be available to you after. So I will make sure that they get uploaded as well as the recording. But with that being said, affordability, principal and interest as a percentage of income. This was something that Luis kind of alluded to when he was sharing a little bit more on the rates. One of the things that we know right now, right? One of the things that we know right now is that individuals that are seeking to buy property right now are going to have more of their income go to principal and interest than they might have in the last few years, right? It's at about 25.4% as of June of this year, right? June 22. Now, if we look back, that's not much higher than July 06 or June of 1989. We were at about 24.6 and 24.7 respectively on those 2 years here. And yet it feels like a lot more right now. Why? So I said at the beginning that the biggest thing we're combating right now is this short-term memory about what the last years look like. If in January of 2013, we were at the low where only 11.6% was going towards the purchase of a home, then jumping to 25.4, it feels like a lot, right? It feels like a lot. And so I think this is a really important slide to kind of share with with people that are interested in potentially purchasing home right now, to have an understanding of that affordability. Now, here's the other thing, right? Is all of a sudden you see these payments go up. I think it's also important to look at, you know, some of the expenditures that we have in our daily life, and how can we help our clients to see the option, right? How can a buyer really look at making this more quote unquote affordable, right, for them? Now, here's the thing. We all have expenses in our daily lives that maybe we don't always need that add up, right? How many times does somebody eat out during a month? And depending on the size of the family, that can be a pretty big expense. So is there the potential there to kind of increase or decrease part of that monthly budget and increase the amount of money that can go towards the home by maybe not eating out and all of a sudden getting an extra $200 in the budget, right? Or coffee. I will say this, I know myself, I love going and getting my coffee, and yet I've been brewing coffee at the office, right? And I've been fairly good at that recently as well, because we know those little expenses, they add up. They're the little luxuries that kind of add up. How many streaming services does somebody need? These are important parts of the conversation to have when we look at this idea of affordability as kind of this combination of principal and interest as a percentage of income. But this is kind of where we're at right now. So again, it feels a lot higher. Now let's look at what's happening in the real estate industry, especially in the United States. Home sales. So what's really interesting is that for a lot of us, it felt like the last couple of years there was so many home sales that were going on. So I'm going to note on these numbers, you would double it because there are two sides of a transaction. There's the buy side and the sell side. And yet this is how many homes sold, right? How many total sales happened throughout this time. So 2018 to about 2021, there was about 27.4 million homes that sold. In retrospect, there was actually a lot more homes that exchanged hands in 02 to 06 at about 32.2 million. So that's really important to kind of look at when we're projecting, right? Here's the other thing. The projected year-end home sales for this year is about 5.1 million. Now, for many, it may feel like home sales have slowed. And yet this is pretty similar. It's not that much different to what was happening in 2018 or 2019. It feels like a major decrease because last year was so high, right? But again, There was a lot of money that was infused into the economy during that time. Now, if we look at this monthly, then we can see where some of those adjustments are being made. Obviously, seasonality was kind of affected by the pandemic. Usually we see the biggest number of home sales, especially in our areas, go up in the second and third quarter of the year. And that was not necessarily the case, right? Look at here, when we looked at 2020. And so we're seeing kind of this adjustment that is happening right now, because we saw this kind of pent-up release of demand that happened in the third and fourth quarter of the year, which is why even right now, as home sales kind of start to slow a little bit, it feels a lot more impactful when we are not taking seasonality into account. Now, home prices. Again, this is another money slide, my friends, right? This is some of the slides that I think anybody that is considering purchasing should be looking at, should be paying attention to. I want to know, if you bought a home in 2006, right? Here is the height of what we had seen at the real estate market before the last housing crash, recession, etc. Somebody that bought a home in 2006, they bought a high amount here, right? What the national average was at that time. And then all of a sudden the market started going down, right? They hit the low in 2011 was where we hit low. And yet, where does that home return to value, right? It's about here at 2000, it's actually between 2015, 2016. So about 10 years for that home to return to its regular value. Now, a couple things that are important to understand about this. During the last major market crash, right? The last housing crash, one of the things that we saw was a lot of variable rate mortgages. There are adjustable rate mortgages available now. Those are the ARMs, right? So there are options that exist for ARMs, but there was a lot less regulation in the mortgage industry that occurred. What that generally meant was that somebody did not have a fixed payment for 30 years, okay? And so, yes, there was a lot of individuals that when they went underwater and all of a sudden their payment amount, right, their payment amount went up, it adjusted up because of the change in the rates and the change in their mortgage, they could not afford to make those payments. I want to use it, but that is not the case right now. So I want to use this as an example. I think it's important to acknowledge that that was the fact there. We do have a lot more options that exist right now. The majority of the loans that the buyers are getting into right now are fixed rate mortgages. What does that mean? It means that they lock in a payment for a certain amount of time. Even if they have an adjusted interest rate or we buy down the rate or these different things, they're gonna lock in a payment in that loan type. So in a fixed rate mortgage or in specific loan types, they will lock in a payment for 30 years, meaning that the amount that they are paying is the same every month for 30 years. If that is the case, we would do that with a rent payment, and yet rent goes up. It went up in California 10% in August, right, for most people. So what does that look like, right? If all of a sudden we know that rent continues to go up and yet somebody could lock in a payment that is fixed for 30 years, that payment doesn't change, okay? If they had lost value in their home, they're still putting it, right? So they're paying into it just the way you would pay rent, except the rent is probably going up in most cases, right? So they're still paying into something. If they kept that asset long enough, so if we all of a sudden get over here to 2016 and the property value has now returned to what it was in 06, what is that individual gain during that time, right? They've had a fixed payment, meaning that they didn't have to deal with rent increases, right? They didn't have to deal with rent increases. And now that their property has recouped value, if they sold it today, they would have equity. They have an asset that they can borrow against, that they can sell, and they can actually take money out of it. It's like having their own little mini bank account, right? That has been saving their money for them in the form of a house. Had they rented during that same amount of time, that money is gone, or it's not gone, the landlord has it, right? But that money is gone. And so I think this is really important to look at. If homes go down in value, so long as we're comfortable with our payment amount and we keep our job and something doesn't happen that takes us away from working, we still have opportunity here, right? We have opportunity to gain equity. We have the tax benefit that comes from owning a home and contributing to that home, right? So we have an asset to borrow against in the case of emergency. There's a lot of different benefits that come with the home. Now we know that homes on average, in all these years, the average rate of appreciation is 4%. We did see obviously a major jump the last few years in terms of what that looked like. And so it surpassed that national average that we've seen over time. And yet, even if we saw a market decrease, and this is important for the buyers that are out there, even if we saw this kind of market go down and us experience a major downshift in price, it's not about, this is why Gary Keller says, don't wait to buy real estate and wait, is because when that asset is held long enough, it will always recoup its value because it goes up and down on an upward trend, right? And they're making deposits into that account that when that property recoups value, and this is only if it goes down, right? When that property recoups value, they have that equity built into the property here. Okay, so let's talk about home prices monthly. Obviously, we saw some major jumps. This last kind of year was a huge, we experienced probably the greatest rate of appreciation that we've seen, and mortgage rates stayed fairly low for the majority of that until we hit about 2022. So just another kind of look at what was happening. Inventory, right? Inventory contributes to supply and demand. So when we see a lot of inventory coming into the market, right, we see adjustments in price. Surprisingly, we did not see major, we saw a little bit of price adjustments, right, when we had the shutdown, but we didn't see too much change because all of a sudden inventory started going down as we saw home sales go up. Days on market, we saw that increase. That was actually much higher at the start of 2020 and has slowly kind of been going down. We are still fairly low on days on market. This is going up a little bit right now, but the average has stayed fairly low in comparison to the last 2 years. And then mortgage rates. Again, another money slide, my friends, right? Another important kind of piece to look at when you're thinking about what is going on with the mortgage rates. Now, I said short-term memory is the biggest thing that we deal with for ourselves, for clients, right? For all the buyers that are out there, is because the last few years, we've seen mortgage rates stay very, very, very low and drop incredibly low. You just heard talk of the mortgage rate right now being for conventional in the 7s already, right? It's in the 7s, and everything else is about 6.9, is just touching that 7, right? And yet it is lower than the historical average from 1972. One of the things they shared was that it was in the 80s, right? In the 80s is the last time that we saw inflation being as high as it is now. And in the 80s, the rates hit all the way up to about 16.63, right? Pretty high. And yet that's just part of the market, right? It's borrowed money. It's paying the interest on this borrowed money. And yet it still gives us that leverage to go in and purchase. So is more of the payment going to interest than principal than was before? Yes. And yet we are still lower than the average from 1972, considering that inflation is fairly high as it was in the 80s. If inflation stays high and doesn't start to drop a bit, I would anticipate that we'll continue to see these mortgage rates kind of continue to rise. It is also unlikely, unless something major was to happen in the economy, that we see interest rates kind of return to these numbers again in the low 2s and 3s. But again, there's always buy downs. And this kind of just gives us a look at the mortgage rates from a monthly basis as we kind of go over that piece as well. Now, let's talk about what's happening in the industry. There's going to be a couple slides here that are also the money slides, my friend. Economic risks of what is happening right now. Of course, if the Federal Reserve kind of continues to over tighten, that tends to adjust. It is very hard, right? As you saw in 2020, when we saw the GDP drop so significantly, all of a sudden a lot of money was infused into the economy and the GDP jumped up way too high, right? Which has kind of contributed to this market that we've seen the last 2 years. It is very difficult to kind of pull all the right levers to get the economy exactly where it needs to be. And so sometimes there's over tightening or overstimulation that occurs. The last 2 years are kind of the result of some of the overstimulation of the economy that happened at that mid kind of 2020 point. Now we're kind of feeling a little bit of that tightening. And so there's always the risk that the Federal Reserve over tightens. Global spillover from slowing Chinese economy. And we saw they're one of the biggest biggest suppliers of consumer goods. And so when we see that kind of slow, or the ports get tightened up, or all of these different things that happen, that is felt across the world. And then escalation of global conflict and trade barriers. We've seen kind of what is happening with Ukraine and some of the things that happen there. That all impacts our economy as well. Now, this is big, right? Because we looked at percentage of principal and interest as a percentage of income, right, as one factor. So how much money is going towards getting a home, right? We looked at prices and how the properties appreciate in value over time. We looked at how interest rates are likely to continue to rise, and yet so is rent, right? And as inflation continues to go up, so does rent. Rent just went up in California in August, 10%. That is a big jump for a lot of people, right? Here's the other piece, is that aside from rent control, right? Aside from rent control, rent continues to go up. Now, rent control doesn't mean that the number stays the same forever. So it's not like, hey, my payment is $1,500 today, and because of rent control, it's going to be $1,500 next year. No, it means there's a limit on how much it can increase in most cases. And so what does that mean? It means that the rent continues to go up because the landlord has a right by owning that property. Their property taxes go up, all these different things go up. They can choose to raise the rent, right, on an annual basis based on the guidelines of whichever area they're in. And so rent, one thing we know to be true is it will continue to go up. That is very different from having a 30-year fixed mortgage where your payment amount stays the same, right? So there's benefit here on what that payment amount is when we have that control over it. Even though we know that as a percentage of income, yeah, the principal and interest is going to be higher. And yet when we own and we have a mortgage, we at least have control over that payment amount, and we get the tax benefits, right? And we have an asset that we can borrow against in case of emergency. There's a lot of different things that you can do that you can't do when you're renting and your rent continues to go up. And so this is really important to have an understanding of as well. Now, this slide, I want to explain this one for you guys, because this is a really great way to look at what is happening when it comes to rent versus owning and some of the benefits that you have with renting versus owning. Okay, so I want to imagine that it's 2012, right? I would imagine it's 2012. The average price of a home in 2012 is $177,000. Nationally, I know California is a little different, but the average price of a home is $177,000. And you buy that home with 10% down, right? You put 10% down on your property and you buy the home in 2012 and you keep it for 1 year and then you sell it. Minus the cost that it takes to sell the property, the equity that you gain is $9,980. Okay, so that's that amount here. Now you buy that same home in 2012, you put 10% down and you keep it for 5 years. And then you decide to sell. And that equity that you've gained is $74,154. Okay. Same home, bought it for $177,000 in 2012, kept it for 10 years before you decide to sell. Minus that cost of sale, you're looking at $206,676, right? That's the equity that you gain. Because remember, when we buy and we're putting money in it, even though we know home prices go up and home prices go down, right, is we're gaining equity when the price goes back up, or when the price is we still have that equity that we've gained over that time. Plus we have the tax benefits, right? So this is what owning looks like. Now, let's go over here. What if I decided that I'm going to rent, right? And I'm going to put 100% of that money that I would have put into owning a home, and I'm going to put it in a Vanguard fund, right? A Vanguard fund, because I want the benefits that the Vanguard fund is going to get me. And so I've decided that I'm going to continue renting, but I'm going to put that same amount of money that I would have put towards buying the home, and I'm putting it in the Vanguard fund. And so I leave it there for 1 year, and yeah, I'm going to make a little over 26,000, right? Is kind of my return on my investment, but I'm still renting. You know, at 5 years, actually, I mean, if you look at this, at about year 3, you're even to the home. Okay. So 42,787, we're even to my home. By year 4, 5, 6, look at year 10, right? It's almost double. You would have made almost double through owning a home. Now, the truth is, though, is most people are not going to rent and then also invest all that money in a Vanguard fund. So let's say they rent and they only invested 10% into a Vanguard fund, right? Only 10%, because we know that the average person they may invest nothing, or they may invest a little bit, but they're probably not investing that full amount into a fund. Now, in year 1, okay, still 22,000, right? Almost 23. By year 3, owning beats this out, right? By year 5, it's almost double. And by year 10, I mean, look at the spread here, right? Owning wins out every time, right? Owning long-term wins out every time, because again, it's not about how much we are, it's not really about how much we are, how do I put this? It's not about waiting to buy the real estate, right? Because everybody wants to wait. Oh, I want to put my money into a fund and see if I can make my down payment grow. I had somebody ask that, should I put my down payment into a high yield savings account and just wait for the market to change? And I can't answer that for an individual person. We can't answer that for an individual person. Everybody has to answer that for themselves. But I think this is a great way to look at what actually happens when we purchase and we hold long-term versus when we rent and we maybe invest a portion of that, right, somewhere instead of buying. Where do we really get that highest level of return? So I think that's a good piece to. Now, with that being said, my friends, I wanted to kind of bring it to an end here. Some of you had heard me say this before, and yet I'm going to say it again. We are in a really interesting real estate market right now, right? We're in a really interesting real estate market right now. Interest rates are going up. The economy, you just heard me talk about. There's so many things that are happening with inflation, with the GDP, kind of this recessionary environment. And so it's kind of like this storm. And what's really interesting is most animals in the midst of a storm, right? They run or they hide. And by trying to outrun the storm, or trying to hide from the storm, they actually get caught in the thick of it, and they get caught in the worst of it. And I heard this from Gary Keller. I stand on the shoulders of giants, and he said that the buffalo was one of the most unique animals that existed, because the buffalo doesn't run away and it doesn't hide. It runs right into the storm. It charges the storm. And by charging the storm, it gets through it faster. It gets through it unharmed. And part of showing you what is happening in the economy and what is happening in real estate right now is for one purpose and one purpose only. It's because now is the time for you to charge the storm and to really have an understanding of what is happening and how you can utilize that to your benefit. So charge the storm, my friends. With that, I will see you tomorrow at our meeting. I hope you all have an absolutely phenomenal rest of your day.
Thank you, Monica.
Of course.
Thank you, Monica.